Hi everyone, welcome to Finance on Friday. We're just waiting for a few more people to come in, so if you want to say hi in the chat, please say hi. Please tell us what you'd like to learn about tax allowances, and yeah, hopefully we'll be covering that today. Okay, should we get started, Julia?
Yes, we might as well.
Okay.
Simon?
Hi everyone, thank you for joining. I'm Simon, I'm one of the money mentors here at Women's Wealth, and today I'm joined by my wonderful colleague, Julia.
Hi everyone.
Finance on Friday is a Women's Wealth broadcast where we spend half an hour talking through some of the latest information and topics that matter to our members. Today's topic is what you should be thinking about as the tax year end approaches. And the idea really is to make as much of your allowances as you can. But I just wanted to reframe that a little bit. So instead of it being about panicking at the tax year end, making sure you've got everything, I wanted to think about how it's a way of getting as many free things as you can, and both at the end of this tax year end and not just at the end of next tax year, but in next tax year and every tax year afterwards, just making sure that you're making the most of those allowances because they really do make a difference over time. And so some examples of the sorts of things that we're talking about here is the government bonus that you can get on pension contributions, not paying more tax than you need to on your emergency fund. We'll talk about how you can use a cash ISA to protect against that. We're going to talk about how ISAs are a tax-free shelter, so explain more about what we mean when we say a shelter, and then talk about a real freebie, which is £720 free on pension contributions, and when you contribute £2,880 to them, and also a little known allowance called the Marriage Allowance, which can be worth £252. So yeah, the first example I wanted to talk about was just to give an example of a scenario really where someone could make the most of their pension contributions or the bonuses that you can get on pensions in a year. The headline story with pensions really is that pensions are incredibly generous. So from a tax point of view, so whatever your position is, whether you're self-employed or employed or anything else really, you want to be thinking about how you can make the most of pensions, because they'll get you where you want to be more quickly. And so in this example was someone who was a teacher, so they hadn't really been thinking about pensions. That was all done for them really as part of their role as a teacher. But after their teaching career, they started their own business and became self-employed. And so what that meant was that they had to do pension for themselves. So the business was going well, so they had savings, and with those savings, they basically paid tax on that. And so they were wanting to retire in around 10 years' time. So then it became about, well, what could they do with that money that they'd saved? And with pensions, they could basically say they had £10,000 saved that they didn't need at that time, was for their future. By putting that £10,000 into a pension, they would get a government bonus of 25% on top of that pension, which is a great deal. And as I was saying at the beginning, is a way of basically getting free money, because you've already paid the tax on the money that you have. So by getting that uplift from the government, you're then getting something for free. And yeah, the way that the tax relief works is different in lots of different situations, but basically you will get relief at the highest rate of tax that you pay up to certain limits. So a higher rate taxpayer would not only get that bonus, they would get an additional 20% tax relief on that. I should also mention salary sacrifice and how important that is. So if you are employed and you're getting paid via PAYE, by diverting salary into your pension, you both save the tax and the national insurance on that, which means you have a lot more money to invest than you would have if you just took the net pay. Obviously, it's tied up in your pension, but if we think of pensions as a way of getting where you want to be, say in 20 years' time, in 30 years' time, then using that tax efficiency can mean that you get there more quickly and build that pot more quickly. So the second example really is how, if you have an emergency fund, so we recommend that our clients have an emergency fund of 3 to 6 months committed expenditure that they keep in an easy access cash account, and that means that you're covered against anything unexpected, or if you lost your job, then you have that cash there to cover your expenses for a time. But
Simon, may I ask,
yeah.
so is it the 3 months or the 6 months of emergency fund that you recommend?
Well, we normally start by saying 6 months, because, so say if you have income protection insurance, that tends to kick in after 6 months, and that's an insurance that would provide protection if you're unable to work due to illness or injury, for example. So yeah, that tends to kick in after 6 months. So the idea is that you'd have that 6 months in cash that would cover your expenses. You could, it depends on how you feel about it, depends on what your plan is in that situation. So you could have, as long as you have at least 3 months, then you have that buffer there and that protection. But by having 6 months, you have that 6 month, it might bring you peace of mind to know you have that 6 months. It allows you to get away from a job that you don't like, get away from a situation you don't like, and yeah, it just gives you that security of knowing that you have that money in cash. So yeah, thanks for the question. But yeah, and then thinking about the tax on that. So if you had, say, around £25,000 in savings, you would be earning around 4.6% interest on that at the moment, which is 1,150 a year. And so if you're a higher rate taxpayer, for example, you might be paying 40% tax on that. So if the point here is that if you have cash ISA allowance available or ISA allowance available that you're not using for investing, then it might be worth thinking about protecting that interest against the tax on it by putting it into a cash ISA. There's a question there. Is there a tax threshold for savings that aren't in an ISA? So if you're a basic rate taxpayer, you get a £1,000 each tax year savings allowance. So up to £1,000, there's no tax on that. Then you're taxed above that. But if you're a higher rate taxpayer, that allowance is £500. And if you're an additional rate taxpayer, sadly, you don't get any savings allowance. So all of your savings is taxed. So for example, if you were an additional rate taxpayer, you might consider holding your funds in premium bonds. Premium bonds, obviously, you're not guaranteed a return, but the returns that you do get are free of tax, and you can hold up to £50,000 of those. But basically, the prize rate on premium bonds is around 4%. So while you're not guaranteed, you can sort of say because it's tax efficient, then yeah, that's where you want to hold your cash in premium bonds. So you want to talk about what we mean when we say sheltered from tax in an ISA.
Yes, thank you, Simon. So what do we actually mean when we say individual savings account shelters investment from tax? So if we look at individual savings account and general investment account, both invest in stocks and shares with the original sum of £20,000 over 20 years with assumed growth of 6% a year. At the end of 20 years, we will have a gain of £44,142. So if you were to hold this investment in ISA, you will benefit from no tax on dividends and no tax on gain. Keeping it in the general investment account, you will of course be taxed on a gain of 44,142. It will be subject to capital gains tax at 18% for a basic rate taxpayer and 24% for a high rate taxpayer. And of course, capital gains allowance per tax year stands at £3,000 per person per tax year. And the advice we give is, of course, get the funds into stocks and shares ISA as soon as you possibly can.
I'm going to ask Julia. So we're talking about a gain there by investing into a say a stocks and shares ISA. What would you say to someone who thinks that investing is too risky for them or doesn't know where to start with it?
I certainly agree that investing is risky, but investing carries risk and reward. And the more risk you take, the more reward you will gain. But the biggest risk is actually leaving the cash in the bank, especially over the long period of time. The purchasing power of the pound will erode over time. And from that perspective, cash in the bank is more risky than actually investing.
there's a risk built into cash, isn't there? Or not a risk, actually, a guaranteed you won't be able to buy as much with it if it's for your future as you could if you invested it. So by leaving it in
Absolutely.
cash, you leave yourself open to that risk. And yeah, we often say that without taking a risk in investing, there is no return. So it depends. Do you want those returns for long term, or do you want to leave your money in cash and have that guaranteed loss built into it? So we're quite big on not holding too much money in cash, basically.
Yes, absolutely. And another element, or tax freebie, if I can put that way, I would like to talk about is £720 of free pension contributions if you make up to 2,880 a year into a registered pension scheme. So it is available for children. It is also available for people up to the age of 75. Most people benefit from it through their workplace pensions, and it is also available to people who are not doing paid work at the moment. So when my child was born, I wasn't aware that he can have a pension plan, and but later I discovered that yes, but he can have a pension plan, and his contributions will attract tax relief up to 3,600 a year. So, and I'm trying to educate my 6-year-old on a time horizon and financial perspective, so he has this instilled with him from early ages, and by the time he actually comes to claim it, hopefully he'll have a much bigger pot, because the sooner you start, the bigger it will become.
And is he convinced by that? Because it's not always easy to do something for even for grown-ups to do something for their future selves 20 years down the
To be
line. So
honest,
yeah, how does he feel about it?
yeah, I think we're struggling at the moment, because I think if you offer him cash money now and purchasing a Lego or Minecraft, of course his response will be yes, I would like to have it now. But we are working on it. We're trying to explain how it will work in his later years. So hopefully it will eventually come to him, and he will change his perspective going forward.
Yeah, because you can't get Lego when it's in a pension, can you? So, and I think I was thinking, so that's a decision for all of us though. So say if you're paying quite a lot of tax and you get a bonus, then you can divert that bonus into your pension, which is really, really tax efficient. But also we all want to balance living now with living in the future. So if you want to go on holiday with your bonus, then you're I think what we would always say is it's not about always pursuing the tax efficiency or always pursuing the now. It's about getting a balance, and it's about thinking, yeah, I do want that holiday and that experience now. So I'm doing that having understood that, yeah, I could get that tax efficiency, but I'm choosing not to right now. So yeah,
Yes,
a good
totally agree.
skill for your son to get into right now, or at an early age. And we had a couple of questions actually. Is it best to leave an emergency fund, a fund ISA in the current bank, or top up a trading account? So really, I think if you want to have that emergency fund that you've decided is your emergency fund. So let's say 6 months is your emergency fund, and have that in an easy access account that's earning as much interest as you can get on that. And then money surplus funds that are for your future, then you do want to be thinking about investing that because of balancing that risk of the inflation by just leaving it in cash. Cash doesn't do it over the long term. At the moment, you can get quite good interest rates on cash holdings, but we don't expect that to hold in the long term. So if the cash is for your future, then you need to be thinking about investing that cash, as long as you've got this emergency fund in place, because you also don't want to be investing money that then you need in the next couple of years. So you need to have at least a 5-year time horizon to be investing money, because you wouldn't want to be cashing it in at the wrong time, as when markets have just fallen, for example. And then there was another question about whether you can pay rental income into your pension. So rental income doesn't count as you can't pay rental income into your pension. So you would just be limited to that 2,880 that you just talked about, and you could get the £720 bonus on that because you don't have to be a taxpayer to get that each tax year. So, for example, as we're just approaching the end of the tax year now, you could do one of those contributions today, and then you could do another one on the 6th of April and get 2 times that £720 bonus. Amina asked about to reduce tax on dividends. So really, to reduce the amount of tax that you're paying on dividends, you want to have as much of your investments as you can sheltered within an ISA. And there are some slightly more tricky aspects to dividends specifically, but I don't feel like I can get into them right now in this. So if you wanted to email me, you can. My email is simon@womenswealth.co.uk. So if you have a question, feel free to get in touch via email as well. And then an additional example we wanted to cover today was that it's called the Marriage Allowance, and it's quite an obscure one, and it's the sort of thing that you can miss, and unless you're a bit of a geek about all the allowances and free stuff that's available. And so this is it for the scenario where in a couple, one person is working and the other person isn't doing paid work. And so what you can do is you can transfer the personal allowance of the person who isn't doing paid work to the person who is doing paid work. And so that means that the personal allowance is the section where you're taxed at 0%. And so that means if you transferred the whole personal allowance from the person who isn't working to the person who is working, then this saves you £252 in tax. To do this, you can apply online on the gov.uk website. And so it's just a way that you could get £252 save £252 in tax if one in a married partnership wasn't working and the other one was.
Simon, could I please ask a question if the same rule applies to couples who are cohabiting?
No, unfortunately not. This is just for married couples and people in a civil partnership. So yeah, it doesn't apply to that. So if you really want the £252, you could get married to make sure you get that. But I'm not sure it would be a profitable deal. Maybe only over the long term, but yeah. Oriane's asking, what does the 2,880 cap refer to? So do you want to answer that one, Yulia, or shall I answer?
I can try. So if you contribute throughout the tax year £2,880, you will benefit from £720 tax relief. So this is the minimum amount that is available for people who are not necessarily doing any paid work, or people who are up to the age of 75, or even children. So this is the minimum cap that is available to everyone, subject to those criteria. Is there anything else you would like to add, Simon?
No, so it's like you said, I guess the really simple way of thinking about it is your example of your son. So your son doesn't have to have a job, but he could pay 2,880 into a pension and get £720 top up. So then it also applies if you only had rental income, you can still get that 2,880. You can still pay 2,880 into a pension and get a £720 bonus from the government. And yeah, if you stop work but you're under 75, you can also still get that. And maybe that reminded me of so one thing you can do is that once saw an interview with a woman who, she was wealthy, she was quite successful. She had this idea of paying £2,880 a year into her child's pensions when they were small, and getting that bonus, then investing it. And her idea, which I quite liked, was then she knows that their financial future is secure. So they're from the age of currently 57 onwards, they would have a significant pension pot to access. But she also felt like it was a way of going, well, you've got to go out into the world and do something, but you know that eventually you can come back and then you'll have that security in the long term. So I thought that was a neat idea and a neat way of using one of these allowances that you can get. Sharon said, does the bonus go into the pension pot? Yes, it does. And one thing I'd add, if you're doing it yourself, make sure that make sure that the money going into the pension, sorry if this is obvious to everyone, but the money going into the pension needs to be invested. So don't just leave it in cash in there. It needs to be invested, and then you usually get the bonus about 6 weeks later if it's something you're managing yourself, and then that needs to be invested as well. Okay, so we had some other examples of the types of freebies that you can get. We had you can put money into a junior ISA, so up to £9,000 each year for a child, but then you have to remember that full control of the ISA goes to the child from age 18, and then they can do what they want with it. So I would suggest that can only be something that goes along with financial education, and yeah, depends on the child, depends on what you think they'll be like with the money when they reach 18, which has a lot of uncertainty in it, doesn't it?
Absolutely.
And then capital gains allowances. So everyone, if you have money that isn't in an ISA, so if it was in a general investment account, say, then gains on that above £3,000 are subject to capital gains tax. So each of us has a £3,000 each tax year capital gains allowance, and if you're married or in a civil partnership, you can transfer that between the partners. There's inheritance tax has become a bigger question recently. So with the expected move for pensions to be included in people's estates, and the thresholds for inheritance tax haven't moved for a long time, so more and more people are getting caught into that inheritance tax band, and then having to pay, or risking their children having to pay 40% inheritance tax on what they inherit, which is a bit painful for them. And so you can take, but you don't have to just take it. You can take steps to mitigate that. So there's an annual gift allowance. You can make gifts out of regular income, and there are other tax planning tools that you can use if it's a significant concern for you. So, for example, setting up trusts or gifting money to children and grandchildren. One of the other key things that, again, because the tax limits aren't going up in line with inflation, so more and more people are being caught by the high rate of marginal tax at just over £100,000 of salary. And so one way you can mitigate against that is you can use pension contributions to reduce the amount of tax you pay. So by contributing to your pension, it effectively reduces your taxable income for the year. And so if you say just went over £100,000, there's a situation where people lose contributions to childcare costs and then start paying a really high rate of tax. So by being aware of that and by making extra contributions to your pensions, you can then reduce back down to below the £100,000 limit, and then save lots of tax on that. It's become such a cliff edge that, in an ideal world, you would find a way to plan for that and save for it if you know that you're gonna start earning above that amount. And then, yeah, one final thing to mention is that you can get pension allowances going back for 3 years. So yeah, if it was appropriate to you and you had a large amount that you want to divert into pension, you can use your pension allowances going back 3 years. Did you have any other ones you wanted to add at all, Julia?
No, I just probably want to say that with that pension allowance, I've mentioned £720. So the earlier you get it in the tax year, the longer it will be invested for longer, and therefore it will help your savings over the long term. That will be the one I will just add as well.
Yeah, so with all of these things, the sooner you do them, the better. So in an ideal setup, you don't open your ISA on the 5th of April, just before tax year end. You'd open it on the 6th of April for the new tax year, at the beginning of the tax year rather, so that you then got the whole year of growth tax-free. And then over time, then that obviously optimizes your financial plan, your investments as well. Yeah, so if any of this has been of interest to you and you'd like to explore how you could work with us to improve your financial position and your financial well-being, then you can book a time to talk with one of our money mentors via the website. I'll just put a link to that in in the chat. Are there any other questions we missed as well, Julia? Oh, there's one about whether we recommend any insurance, such as life or health insurance. So obviously, as a general way of thinking about it, you think, what happens if the worst case scenario happens? So with life insurance, then what would the people I leave behind need? And yeah, have we got that cover in place? So that's the way to think about life insurance. We talked about income protection insurance. So that really is for the situation where you are unable to carry on working due to illness or injury. And so when you look at the statistics, a relatively high number of people will have a spell of not being able to work due to ill health in their career. So you can get an insurance to insure against that risk. And so it's interesting, we insure our houses, we insure our cars, but we don't insure our asset, which is our ability to earn money. So income protection insurance can provide protection against that. So as part of, if you chose to work with Women's Wealth, that would be one of the things we looked at, is how does your financial plan look in terms of, if we stress test it, do you have what you need in place? What would you do? Would this insurance be beneficial to you? And so, and then health insurance, so you can get critical illness cover. So if you're diagnosed with one of the illnesses listed in the policy, then it pays out a certain amount. So you can get that kind of insurance as well. And then really that's the question about what would you need to help you to recover from each kind of diagnosis, and then thinking about what money would make you feel better about that risk, really. There's one question there about slightly running out of time, but how can you add to your pension for the last 3 years? So really what it means, what the 3-year carryback thing means, is that is your allowance. So if you contribute more than the annual allowance, then basically you may have to pay some tax when you do your tax return, because you've gone over that limit. So if you have that limit that's available for the last 3 years and you're contributing and you're not going over that limit, then you won't have to pay additional tax. And then there's a question about tax on savings for children's accounts. I guess that depends if it's held in children's names. So it depends on how much money we're talking about, but potentially a way around it, in that you can get accounts that are in the children's names, which, okay, they are held in their names. So I think as we're running out of time, Sharon, if you send me an email, we'll be able to answer your question on there in more detail, if that's okay.
I would also like to add that as part of our membership, we offer a review of existing arrangements, including dependents. So if you would like to proceed, we will be able to review and recommend your current arrangement, as well as for your children, for your dependents.
Oh, great. I think we're running out of time, so thank you for joining Julia and myself today. We hope you found it useful. You can join Women's Wealth free by signing up for our Enable membership, and then you can get access to the content, so previous finance on Fridays, and there's a course on learning how to get started investing, and yeah, lots of interesting resources on there and useful resources on there. So yeah, we're also authorized and we're regulated independent financial planners. And yeah, if you'd like to explore having a more personalized one-to-one service, then you can obviously upgrade your membership from that Enable package to become a full member of Women's Wealth. Our next Finance on Friday is on the 25th of April, Friday the 25th of April at 12 p.m. And we'll be talking about socially responsible investing, or what's commonly known as ESG then. So yeah, thank you for joining us today, and hope to see you again in the future.
I look forward to seeing you again.